All right, we have a lot to digest this morning. Earnings, trade headlines, and then the bigger story about where the economy itself is headed. Now, in the midst of all of that, and I'm sounding like a brokered record, but we have seen records in North American stocks. The TSX and S&P 500 have been right around all-time highs. What's the story look like as we roll through the summer? Let's get perspective from Chhad Aul. He's Chief Investment Officer and Head of Multi-Asset Solutions at Sun Life Global Investments Institutional Asset Management, SLGI. Good to see you.
Great to be here.
Okay, what do you say?
So you're definitely right. All-time highs across many markets, and yet a lot of skepticism, which I think you expressed to a certain degree. There are pockets of investors that did de-risk earlier this year and are in and around all of the trade kerfuffle early April, and who've been a little bit slow to get back into markets. And that combination is really what drives the potential for momentum to keep this rally going, right? As those disbelievers eventually get peeled off the sidelines and begin to get that money back to work.
I guess in the past it would be like the taxi driver indicator, like when everybody in your life is just talking about buy stocks. Maybe that's a different psychology moment, but we're not quite there yet, you're saying.
We're certainly not there at that level of frothiness. You're beginning to see, if you look at retail traders participating in meme stocks,
meme stock
they're
week,
coming back into that story's starting to perk up again. But we've seen that can get pretty frothy, and in the last several years, that's been maybe the better indicator of that participation getting into the market, right? So there's room to run based on different pockets of investors, like I said, getting back into the market, as some of the risks that we've seen earlier this year, they're still out there, but maybe a path towards more certainty on things like trade are better than the worst case scenario, let's just say. Okay,
let me ask for your expert opinion on earnings, because I have to admit to our audience, I'm a bit all over the place in my assessment of what's going on. Like you can read the data points on how everybody's doing on average, but like we've been flooded this week with all sorts of individual companies who are letting us know tariffs have not been helpful to their business. But I think we keep hearing this headline that earnings overall have been good. So, and then there's different components to earnings. So the earnings from the period that just passed, and there's the outlook for what earnings are going to look like going forward. So if you're trying to assess whether people buy stocks based on valuations and earnings, what are you seeing right now?
You are seeing a little bit of a mixed bag, but you're right, at an aggregate level, typical rates of beating the top line, the bottom line, like we're about a third of the way through earnings season in the U.S. and
it's happening.
At an aggregate level, things look prettle good. There are some areas certainly of concern. Speaks to why you want to be a little bit active in your stock selection. Areas that might be a little bit more immune to the tariff threat. Certainly something that could be a positive. There's areas that have lagged or maybe not lived up to their usual leadership over the last couple of years, like the Magnificent Seven, I think come back into some focus, certainly in the next couple of weeks as their earnings are coming out to a greater degree. And I think there will be, certainly among some of those stocks, a chance for a rotation back towards those themes, towards the AI theme, one that's pretty defensive, pretty immune in general to a lot of these tariff threats as well. That's something that we may begin to see as this year plays out.
I mean, I know you don't talk about individual stocks, but just for the point of this exercise, I'm not sure if we can show what's been happening with shares of Alphabet. I think that's a good example.
It's a great one.
Which has its own dynamics, people wondering if their search business will be dominant in an AI-filled world. But I think, in terms of muscly companies, even though it's come off the lows of the year, it's not like people were banging the table on Alphabet. Then they reported their quarterly results, and people said, they're, generating a lot of money. They seem to be generating a lot of money from their AI products as well. And then they also said, by the way, we're going to spend a whole bunch more, I think like $10 billion more this year than what people even anticipated on AI, and the stock is still reacting well to that. So maybe that speaks to that sort of just that under the hood, the momentum, Mag 7 momentum that you're talking to.
And a little bit of the skepticism, slow to react. Results begin to show the story still playing out. Investors are going to pivot back, I think, towards these names. They may take leadership again as we move into the second half. But I think you really, you pick on a couple of good points there. Well-diversified companies that play the AI theme on multiple levels. So yes, search is not being consumed by AI may be complemented by AI, in fact. Obviously, all of the work on data and cloud services, again, just are money grabs on the AI theme, as well as more and more companies need to use those services as they're exploring their own options in AI.
I mean, it's a fascinating period on that front. We could talk all day about it. I do want to talk about if you're expecting some reasonable momentum for some Mag 7 names. By comparison, the TSX, which has had a better year than the S&P 500, you're up to 60% of the index just being in financials, energy, and materials. And the materials, fueled by gold, have already had a big run this year. Energy probably depends in part on what's happening with the oil price. Financials, I kind of default to you on what the sentiment is there. I guess my bigger question for you is, how do you feel the TSX does for the rest of the year versus the S&P?
I think this is at a reasonable level, good point to pivot some of your Canadian exposure.
This is an
equalizing
moment kind of thing?
It's a great way of thinking of it. Okay. Even the broader ex-US trade that's been so dominant for this year, international markets in general have outperformed, emerging markets have outperformed. Some of that, I think, is due for rotation back towards the US. Canada still has a great complementary nature. You hit all of the main sectors that drive our performance here are ones that are typically you're not getting as much exposure to in the U.S. So it's still a great complement within your portfolio. But at the margins, if you're looking to pick up a little bit more of a boost into year end, I would be making that rotation from Canada towards the U.S.
And can I just ask you a quick question about how bonds fit into the situation? I mean, we have endless conversations about the sort of the ideal portfolio breakdown of equities and fixed income right now. And I would add to that I don't feel like we have the greatest clarity. We have some good guesswork on interest rates in Canada and the U.S., but I don't think we have the greatest clarity on what the rate picture is going to look like heading into 2026. So how do you think about fixed income right now?
Certainly, I mean, the rate picture has become political, of course, in the U.S., adding in further complexity. Yields have been pretty range bound this year, so you've been earning decent income, so yields still pretty high, elevated mostly because of the U.S., the Fed not acting because of tariff uncertainty, probably even less likely to act now because of political pressure. But that's keeping yields at a level where you're getting some good income. Great entry points if you have been sitting more in cash for your defensive positioning. Moving up into a little bit longer term bonds, still investment grade, you're getting that good yield. And if the economic picture begins to shift, which is not the base case, but again, that's what you want to protect against. Suddenly there's a lot of room there, particularly for the Fed, to start cutting rates, and you're going to get some capital appreciation, some offset in your portfolio. So great opportunity, and this opportunity's been sticking around for a while to get into bonds at some pretty good yield levels.
Okay.